I have real fears, not hopes, fears that the gold market will triple.
Hi, everyone. I've got Rick Rule with me once again. Rick, how are you doing?
I'm fine, Mike. The better to be talking with you. Thank you.
Well, it's a great day here in Puerto Rico. Anyway, we were just talking about the economy and what's happening out there. So give me your take on what you see happening today with the debt is one thing that I am just amazed at, and their solutions.
I'll lead by saying I am still amazed at the relative strength of the U.S. economy compared to where I thought it would be. Now, we joked the last time that you and I talked that I've correctly forecasted 17 of the last 3 recessions. So, being a credit guy, I'm normally cautious, but I need to say I'm just amazed by spot labor shortages. I'm amazed too. As you know, I'm retired, sort of, but when I visit with my former clients who are business owners, everyone I talk to say, the nation's going to hell in a handbasket, and there's this wrong and there's that wrong. And I say, how's their business doing? We're great. We're going to have a fantastic year. So we have this odd dichotomy where individual creativity and tenacity in the economy is fantastic. And thus far, it's been sufficient to overcome our collective stupidity. But I'm nervous about allowing the present or the immediate past to allay some concerns about the future. This is why I, like you, remember the decade of the 70s. And I remember the debt that had been accumulated by the United States in the sort of guns and butter era. And I remember that the first half of the decade of the 70s, despite the fears, wasn't too bad. I remember, too, that the interest rates rose. And I remember the discussion in the Wall Street Journal saying, this is an economy that can take a punch. The interest rate doubles and the economy stumbles on. Well, it stumbled on till 1976. And I'm concerned, and I think that your listeners should be concerned rather than terrified about the delayed reaction that could happen in the economy as a consequence of higher interest rates. I'm concerned, too, about the impact of that debt, and I'm particularly concerned, Mike, about the lack of concern around the debt. This is truly perplexing to me. I suspect that because we've gone through 40 years of pretty good economic climate, that people expect the future to be as benign as the past was. And I'm afraid it won't be. Just for fun, Mike, if I might continue, let me cite some interesting statistics. The U.S. federal debt on balance sheet exceeds $33 trillion. Now, it's true, net of the Fed's own balance sheet, that the net debt is, quote, only $26 trillion. Note that that's before state and local debt and before unfunded private pension liabilities. But the thing that really, truly scares me is the off-balance sheet liabilities of the U.S. government, the entitlements, Medicare, Medicaid, Social Security, which is to say you and I, old geezers who forgot to die.
Right.
The unfunded liabilities, the net present value, not the nominal value, the net present value of the unfunded liabilities at the federal level, according to the Congressional Budget Office, not a couple of cranky old libertarians, but rather the Congressional Budget Office, exceeds $120 trillion US dollars. So add 26 trillion, the net on-balance sheet debt, with 120 trillion, the off-balance sheet debt, net present value. You got $146 trillion.
Right.
And you service that with a budget that's in deficit $2 trillion a year. Like the action TV shows today, like the action TV shows used to say, don't try this at home, folks.
Don't try setting yourself on fire at home. Yeah. It's totally insane. You know, I did a video, I think about 2 or 3 weeks ago, and it was just, you know, focusing on the US debt clock, which we've all seen.
Yep.
And, you know, it used to roll over with all of these numbers going forward. And
Right.
now the numbers are going forward much quicker. But just recently, a bunch of those numbers, the currency supply, credit card debt, tax revenues, are going the opposite way. So you've got stuff rolling over forward and then stuff rolling over backward. And so it looks like an extremely dangerous situation at this point.
You know, I'm not one of the big thinkers. You know, I'm not a congressman. I'm not in popular media or anything like that. I remember, Mike, a little dictum.
Those are not the big thinkers. I'm sorry.
Well, they think they are. I remember a little ditty that I was taught when I was a kid that I'd love to carve in the wall of Congress. It goes like this: when your outgo exceeds your income, your upkeep becomes your downfall. You know, this isn't tough stuff.
Can you type that up and put it in an email and send it to me for a quote? Because I used to quote, you know, it was Mo Howard, right? The Three Stooges. Mo. He said to his accountant, "I want to know about the outcome of my income and how come I don't get some." So I want that quote that you just said.
Mo for Secretary of the Treasury.
Yes, I think we would be doing a lot better with Mo from the Three. Actually, the Three Stooges could just run the government and we would be fine.
Well, there's an argument to say that's what's occurred. That's
Yes.
You know, the other thing that amuses me, Mike, since we're just ranting, is I was just at an investment conference in Las Vegas, and there was a lot of investors, many of whom are the sort of, from my point of view, the usual suspects. You know, hard money guys, natural resources guys, supposed contrarians. And it's interesting that when I would talk to them about profligate spending and illogical finances, they would agree with me wholeheartedly. And then I graded their natural resource portfolios, and there were companies in the portfolios that were run very similarly to the government.
Yes, they are some of the greatest inflators on earth.
I mean, you look at these Canadian penny dreadful juniors; these guys inflate share certificates much faster than Congress destroys the dollar. So it's interesting that the same lessons that you and I are talking about with regards to government, we have to apply to our own investment disciplines and, in fact, our own households. There are a whole bunch of people, and perhaps this is the root of the problem, that are less interested in solvency than they are supposed prosperity. If I tell a young audience that in order to survive financially in this climate, you have to save. You have to save at least 10% of pre-tax income before you worry about some fancy pair of shoes or a Starbucks. It's a pretty simple lesson, but it seems to be lost on us in our own activities, and it certainly seems to be lost on us the way you vote. Not you. I mean, you move to a tax jurisdiction where the arithmetic is understandable and pretty good. So I'm not casting stones at you. But our audience,
it's still pretty hard to navigate. I've come to the conclusion that government, they see their job as putting a barrier between you and prosperity. Running a business here is extremely difficult with all of the different. They've got a lot of tax loopholes, but then they make it very difficult to use them, to navigate them, to maintain them. It's just very hard. I haven't found any place in the world. I believe John Stossel opened up he went and took out a business license in Hong Kong one time, and it was he could start up you can start up a business in 24 hours. You can be in business, and the barriers they put in front of you in the United States and pretty much everywhere else in the world prevent that and stifle prosperity. But anyway, I'm sorry I interrupted.
No worries.
You mentioned my tax jurisdiction, moving here because things are simpler. They have less burden percentage-wise, but I
Yes,
wouldn't say that it's simpler.
I understand. I understand completely. I understand completely. I guess the other thing that interests me is, well, there's a lot of things that interest me, but one of the things that I continue to be interested in is the fondness of the big thinkers for political solutions to public problems. I'm thinking now particularly about energy. The big thinkers have decided that we're going to be carbon neutral, depending on the time frame that you have in mind. They say by 2050. And it's interesting when you listen to the narrative, it's all seemingly about the unborn and salamanders and stuff like that. And it doesn't seem to go very well towards arithmetic. Let me give you some of the arithmetic around that. The first piece of arithmetic is this. Humankind has now spent over the last 40 years, over the last 40 years, just shy of $5 trillion on alternative energies. And we've reduced the market share of fossil fuels from a high of 82% all the way down to 81%. This is not a typo. A $5 trillion investment has reduced the market share of fossil fuels by 1%. Another statistic that's interesting, if you are a Chinese person or an Indian person.
Wait a minute. So it's 1%, but that was over what time period?
40 years.
40 years. So the net growth of consumption, though, is
That's
still
right.
way up. So
I'm
we're
not
producing a whole lot more carbon, even though the percentage of net energy usage, oil or oil is taking a smaller percentage.
It is certainly true.
It's grown by a tremendous amount. So the $5 trillion investment really hasn't done anything, is your point, right?
That's precisely my point. Going forward, the circumstance becomes, I think, more challenging.
Hi, I just wanted to take a moment and thank you for subscribing and mention that if you'd like to help our channel, please consider my company, GoldSilver.com, the next time you buy precious metals. We're one of the most trusted names in the industry. Our prices are sharp, delivery is fast, and we have an insiders program where you find out exactly what I'm doing with my own investments. Thanks for making GoldSilver.com your dealer, and now back to the video.
In the carbon debate, the big thinkers believe that the burden of carbon neutrality should be shared equitably. The problem is that their idea of what constitutes equity is found by many people to be unequitable. They want to set carbon emissions totals by country. People in poor countries believe that the carbon emission totals should be set per capita. And I think there's an argument for that. If a person in India generates 10% of the carbon that a person in the United States generates, the idea that you set the total nationally as opposed to per capita probably doesn't make much sense. Further, people in frontier markets suggest that the legacy loadings of carbon were all contributed by people in the West, and that they have a debt. So if you're going to settle this carbon liability, what that means is that the voters in the West need to acquaint themselves with $25 a gallon gasoline and 60 cent per kilowatt hour electricity. I think if you explain the alternatives to people in arithmetic terms, that you will begin to look for solutions other than political solutions. We've seen the future with regards to the economic of energy. That's called Germany, a place that invested tens of billions of dollars in solar where the sun doesn't shine.
Right.
And as a consequence, is experiencing energy shortages in the face of a 500% increase in the retail cost of energy. Amusingly, by the way, now tearing down a wind farm to expand an open pit coal mine. You can't make this stuff up. When I'm confronted at an investment conference with well-intentioned investors who say to me, how can you invest in oil and gas when the industry is going to cease to exist in 2032? Parroting the greatest of the big thinkers, President Biden. I need to say it is highly unlikely that peak oil demand occurs in 2032. It's much more likely to occur in 2065 and then roll off for 40 years. So one of the themes, I think, is that investors, which is my audience more than policymakers, consider arithmetic in their investment decisions. Consider the fact that the oil and gas industry is underinvesting in sustaining capital to the tune of $1 billion a day, because the big thinkers are suggesting they're going to put them out of business. What this means is that oil shortages, production shortages, will be with us for a very long time. And those companies that are making the sustaining capital investments, those few, to maintain current production, will do really surprisingly well over the next 10 years. And despite that, they are very, very cheap.
They're going to do surprisingly well because when you've got a shortage, there's only one way to resolve that, and that's with price, right? So we've got higher energy prices to look forward to in the future.
I think that's right. And excellent returns, I think, for energy investors. Now, the big thinkers are going to do their best to tax those gains away. But, some of the big thinkers, I'm thinking of Governor, I think his name is Gruesome from California. Governor Gruesome both wants to tax the excess profits of the oil companies and prevent them from expanding refineries and drilling, which is to say he wants to eliminate the taxes and then, he wants to eliminate the income and then he wants to tax the income which he just eliminated. I guess that logic stems from the fact that he's from the wine industry.
That is hilarious. So, when we're talking about supply, you're talking about basically supply demand of energy, and you're talking about the price resolving things. Let's talk about the supply demand of currency versus money, precious metals, the expansion, contraction of the currency supply, where precious metals are right now. What are your thoughts on all of this? And then the stuff that seems to be laying in wait out there in the future. We have all these geopolitical problems, and we've got this banking crisis that by no means has been resolved yet, with the losses that are being experienced on bonds, which are the heart of the banking system. U.S. Treasury, people don't realize that in the banking system, the currency that's behind the curtain is U.S. Treasuries. The currency in front of the curtain is the paper, the funny money that they pass out to us when you go and cash a check.
So let's deal with those issues in reverse order, because banking is really first and foremost in my mind. You may know that illogically in retirement, I've decided to start another bank, and I'm in the middle of that. And I must say, I am surprisingly pleased with the competence of the regulators, which is not something that I had anticipated finding. We have experienced a slow response, I would suggest, from the FDIC. And when I made some intemperate remarks about the slow response, somebody from the FDIC said rather dryly to me, Mr. Rule, we've had a fair bit to do the last 9 months. I'm not sure that you're aware of this, but being a banking regulator has not been a picnic. And I think what you say is worth paying attention to. Banking, Mike, done right by mature adults, is a really good business. It's really, really, really a good business. You focus on customer service with your savers. You focus on reducing your cost so that you can pass some of the benefits of that to the depositors. You aggregate the deposits and you lend them prudently. You do something for the savers that they couldn't do for themselves. It's really a good business, and it is by nature a leverage business. The problem is that too many bankers take the attributes of that business to an illogical extreme. The Fed considers a bank with a 7% equity slice to be well capitalized. I'm an old guy now. I've been in banking 40-something years, and I know that sort of 1 or 2 years out of 10, as a banker, you're confronted with some truly ugly surprises. That's the way it works. So the arithmetic that makes sense to me is that 10% is a much better number than 7%. Banks are supposed to have some money in them, equity in them. And we seem to have forgotten about that in the United States. And then there's this problem called duration risk. One of the ways that the unwise in banking make money is that they borrow in the near term and they lend in the long term, and they try and arbitrage those two. The difficulty with that is that if you borrow in the near term on a fixed rate and you lend, at a floating rate, and you lend in the long term at a fixed rate, an increase in interest rates wipes out your business. Some of you will remember the savings and loan business. That's what went wrong. There wasn't a catastrophic decline in real estate prices. There were people that experienced funding difficulties where they had long-term assets and no access to funds in the long term. And that's what happened to Silicon Valley Bank. It's what happened to First Republic Bank. It's what happened to Bank of America's earnings last quarter. In truth, people need to pay attention to their banks. They need to obtain something called the Statement of Financial Condition, which the bank must give you. And the accounting is very, very, very tricky. The regulators allow banks to hold long-term bonds on their balance sheet if they say that they're holding them to maturity with no mark to market, which is to say, if a bank holds a 30-year bond that was bought in a period where a 30-year bond would yield 2, and now the 30-year bond yields 4.5, so the capitalized value of the bond has fallen by half, the bank is allowed to carry that bond on their balance sheet at par.
Yeah, I was just reported on a Bloomberg article, and since March of 2020, Bloomberg said that the 30-year bond had fallen by 53%.
Right. And the banks, if they pretend that they're going to hold that bond on the books, are allowed to carry it at par rather than
to not disclose the losses, right?
Silicon Valley Bank, when they experienced their liquidity crisis, when they had problems, and they had a different problem, they had another problem, concentration of funding. When the overnight funding began to go away and they had to sell their bond portfolio, they had to sell the good part first. And so all the stuff that was floating rate and near term, there was a market for. There was a bid. They sold it and they got cash. All they had left over was the underwater bonds. People need to pay attention to that. Depositors need to pay attention to the solvency of their institutions. Investors need to pay attention to whether or not the institution is run by sober adults. And borrowers, too, need to do business with banks that will be there to meet their funding needs 4 years from now or 5 years from now. Just do a little work. Don't trust the big thinkers to do your work for you. And that spills over into the broad economy. It is true that Citicorp and JP Morgan Chase and Bank of America are literally too big to fail. They will not be allowed to fail.
Right,
but
the taxpayers will pay any losses.
But if you do business with them as a borrower, they will expand and contract their balance sheet, which is to say they are not necessarily good suppliers of capital to you. And you need to pay attention to that. And the length and breadth of U.S. industry has to pay attention to the variability in access to credit afforded by the big banks, given the state of their balance sheets. Taxpayers need to pay attention to something else entirely. Taxpayers need to pay attention to the contingent derivatives liability on the big bank's balance sheet. I realize this is a very boring soliloquy for some of your listeners, but some of the big banks have nominal derivatives exposure of 20 or 30 or 40 trillion dollars on their balance sheets. They will say that these aren't net liabilities, that they offset each other, that they're real liability rather relative to their nominal liability is very low. That's only true if the counterparties pay. If you are trying to operate a $40 trillion derivatives portfolio on a $250 billion balance sheet, it's very difficult arithmetic if there's even one perturbation in financial markets, and I suspect that there will be more than one, Mike. So I'm really concerned about that. I'm concerned about the impact not merely on investor confidence, but I'm really concerned about the impact that a hiatus in funding would have throughout the length and breadth of the global economy.
Yeah, I'm concerned. I feel like things are balanced on a knife edge right now. And I, like you, am amazed at the resilience of the economy thus far. But I just feel like the more the foundation erodes away, the bigger the collapse is going to be when it happens.
You know, you used to live in Southern California, and I don't know if you ever were, but there's a wonderful little bank down there. This is not a commercial for the bank, by the way. I'm a competitor. There was a wonderful little bank called Farmers and Merchants Bank of Long Beach. Oh. Founded in 1910 by the Walker family, run in 2023 by the Walker family. They have their whole net worth in the bank, which means they watch it very, very, very closely. Equity as a percent of assets is about 20. They match their assets to the liabilities. It's a really, really, really well-run bank. And if the country had more banks like Bank of Hemet or Farmers and Merchants Bank of Long Beach or First National Bank of Alaska, we wouldn't have concerns about a credit crisis, but it's not, and we do.
Right. Well, in pursuit of profits, unreasonable risks will be taken, and that's what causes these crises all the time. It's the leverage that's in the system.
You know, it's such a shame. Buffett points out that a community bank is one of the only businesses in the world where a well-run bank can earn 15% after-tax returns on equity and reinvest the 15% at a 15% yield. If you do that without a hiccup for 10 years or 15 years, you've made a truly staggering amount of money. And the idea that the big thinkers take this equation to an illogical conclusion is an insanity.
Yeah. So where do you think all of this points to for, you think that there's a crisis coming. You've correctly called 17 of the last 3 recessions. But where do you think gold and silver are headed?
I am afraid that gold and silver are headed much higher. I say afraid because,
right.
To be completely honest, I'm old and fat and rich. Gold does well during periods of time when people's concern about the maintenance of their savings in US dollars are challenged. In other words, gold does well in bad times. I'm 70. I just as soon not see any bad times. So I'm in the odd position.
It's going to be horrible for the average person, the person that isn't protected with the.
I'm afraid you're right too. I got a lot of questions at this conference I was just at about, will gold break through 2000? I don't care. I don't own it because it would go from $1,925,000 to $2,050. I own it because of the lessons that we learned in 2000, where it went from $253 over 10 years to $1,900. I own gold because I'm afraid, not hopeful, I'm afraid it'll go to $6,000 or $7,000. I certainly don't have the preponderance of my net worth in gold, just like I don't have the preponderance of my net worth in any insurance product. Gold to me is an insurance product. Now, I will admit, on occasion, I speculate as opposed to invest in silver. I do that because in my experience, when the narrative is driven by gold, which is to say when the precious metals market momentum is driven by gold, silver, for whatever reason, perhaps it's lower unit cost, travels further and it travels faster. In my experience, gold has to establish the pattern, but then silver outperforms it. And honestly, Mike, I have no earthly idea what the silver market might do if the gold market tripled or quadrupled.
Right.
I have real fears, not hopes, fears that the gold market will triple. Let me give you, I always revert to math. I'm a credit guy, really.
Yeah.
The market share of precious metals and precious metals related investments, securities, stuff like that, gold stocks, comprise less than one half of 1% of total savings and investment assets in the United States. As Robert Friedland would say, a pimple on an elephant's behind. The 2-decade mean market share of precious metals among U.S. savings and investment assets is 2%. So if concern about quantitative easing, debt and deficits, negative real interest rates became a little more broadly spread in the U.S. economy, and if the market share of precious metals returned to mean, I'm not talking about crushing the bond market, I'm talking about returning to mean, demand for precious metals and precious metals related assets in the United States would quadruple. And that's precisely what I think is going to happen.
Right. When at the peak in 1980, didn't it exceed 5% of?
There are, as I understand it, no accurate statistics, but J.P. Morgan Chase estimates that it was between 5 and 7%.
Yeah, there you go.
Doesn't mean it's true, but we don't need that inflammatory number to make our case, Mike. All we need is reversion to mean. Reversion to mean quadruples demand in a market that's 22% of the world's savings and investment assets.
Wow. Okay. So I think we should wrap this up. Is there any last thoughts that you've got?
Well, one more. I love talking to your audience. I have for years. Any of your audience that would like to talk to me more about natural resource investing, although I'm retired, I welcome them to come to my website, ruleinvestmentmedia.com. List your natural resource stocks. Please no tech stocks. Please no crypto. Please no pot stocks. I'll rank them 1 to 10, 1 being best, 10 being worst, and I'll comment on individual issues where I think my comments might have value. And if you'd like to join me in my retirement in our new bank, Battle Bank, where, among other things, we provide loans against people's precious metals holdings, and where we allow you to save in 22 currencies, not just the US dollar. When you go to Rule Investment Media, in the question and comment section, mention bank, or simply go to battlebank.com. I'm excited enough about this that I've interrupted my retirement to start yet another bank. So thanks for the opportunity, Mike.
Isn't it amazing how, you're retired, but you're working twice as much?
I'm working slightly fewer hours, and I've given up those securities licenses, which I enjoyed, if that's the right phrase, while I was at Sprott, which is a real joy. But like you, Mike, the prospect of retirement wasn't particularly attractive to me.
Yeah. Okay, I want to thank you, and I want to thank everybody for watching. We'll see you next time, Rick. Bye, Rick.
I look forward to it. Thank you.
Hi, I just wanted to tell you about GoldSilver's 111-ounce silver giveaway, where you can win 1-1-1. 1 1-ounce silver bar, 1 10-ounce silver bar, and 1 100-ounce silver bar. So enter today and win.